Hello, everyone. My name is Anthony Barone, and I'm a financial advisor here with Henderson Brothers Financial Partners. Before we dive into today's market review, I want to take a moment to reflect on an important milestone. The year 2026 marks 250 years since the signing of the Declaration of Independence. In just 117 years later, Henderson Brothers was founded. And for the past 133 years, we've been proud to serve our clients and their families. At Henderson Brothers, we continue to embrace the same principles that we were founded on. Our team is committed to helping clients make confident, informed decisions as they navigate the world that continues to evolve at an incredible pace. Today, I'm joined by two of our investment analysts, Senior Investment Strategist John Kirkpatrick and Investment Strategist Joseph Kelly. John and Joe help shape our firm's expectations for asset class performance and guide the decision-making process behind our client portfolios. They'll begin by reviewing market performance in 2025, examining the major drivers of returns and how those forces have shaped today's investment environment. We'll then turn to the economy, discussing key developments in inflation and the labor market and how those trends may influence the Federal Reserve's future interest rate decisions. Finally, they'll share their outlook for stocks and bonds. In addition to today's recorded market outlook, our team has also prepared a brief letter with thoughts on the markets in 2025 and what lies ahead. We're excited to share that with you as well. And without further ado, I will hand it over to John Kirkpatrick.
Thank you, Anthony. Yeah, welcome everybody. Wanted to kick it off with a review of what we saw in the markets in 2025, and thinking back through all of the headlines and potentially all the noise that really existed throughout the year. The markets really dealt with those hiccups very well, and with resiliency. We had new administration come in part their trade policy, tariff announcements. We saw a big market pullback at that point in time, but we saw a huge rebound since those were announced. We've had a lot of advancements in AI, and the AI theme has really dominated news throughout the year. Not all positive. We had a announcement earlier in the year with China's DeepSeek that really scared markets, but then markets came back and the AI theme continued. We are getting some concerns over the capital expenditures and all the money that is being put into the AI space currently, and when will they receive returns for that investment. But it is still a dominant theme in the market. International markets had a great year, really driven by the decline in the US dollar, which fell almost 10%. Escalating geopolitical tensions were some hiccups throughout the year. That really gave gold and precious metals, those safe haven assets, a boost in performance. We experienced the longest government shutdown in history that lasted 43 days. Markets really took that in stride. And then finally, we're getting easing by the Federal Reserve. They cut rates by 75 basis points last year, really signaling a shift in their policy towards easing and focusing on growth versus inflation. So on the next slide, we're going to look through the annual returns of the S&P 500, which are highlighted in those bars, and then the intra-year max drawdown, which is the dots. That is signaling the largest drawdown that occurred throughout the year. We love to show this chart because it really shows, while markets typically have provided an average return over 10% going back to the early 1980s, it is not without volatility that accompanies that throughout the year. The average drawdown on any given year is over 13%. So that we saw an almost 19% drawdown last year. That was above average. But again, the investment comes with volatility, and volatility is a normal part of that process. From an index return perspective, we had a great year across really the entire market. S&P 500 up almost 18%. That marked the third consecutive double-digit return year and the seventh out of the past 9 years that we've had double-digit returns in that index. Despite a slow start, growth really came back and was able to outpace the value style of the market, as the heavy weighting toward technology and the AI theme really was a tailwind for growth companies. Small caps, somewhat challenged throughout the year as the higher for longer interest rate environment really weighed on those small companies' balance sheets. That has started to change, and we're seeing a shift there with the Federal Reserve cutting rates towards the end of last year. This year, small caps are actually the best performing asset class so far. International markets, like I mentioned, standout performers up over 30%, almost doubling returns of the US markets. The decline in the US dollar was a big part of that, but also we're seeing improving growth prospects, increased defense spending in Europe, as well as the AI beneficiaries. Some of those chip makers in Asia are really seeing a nice tailwind there. Moving into fixed income, great returns from investment grade bonds, over 7% for last year. High yield a little bit better at 8.5%. Treasuries posted their best year since 2020. And then finally, broad commodities had a solid year, really propelled from the returns by the precious metals. So gold, silver, those two metals had their best returns since 1979, and gold was up over 60% for the year. Really that safe haven asset really was a big part of the gains there. So looking at historical returns, where does last year fit in relative to history? So that bar we're showing, we're slightly above average, so that 15 to 25% range, that's where we've been for the past 3 years, a little bit above average. This was actually the strongest the strongest 3-year performance going back to 1957. It was ranked the fifth ranking 3-year performance since 1957. The only times where we've seen higher 3 years, like we've highlighted here, are going back to the late 1990s and then one period pre-COVID. So really strong 3-year return window that we're seeing here. Underlying, it's a little bit of a different story. We're seeing a lot of concentration still in the markets with a few companies. So 31% of the names of the S&P 500 were actually able to outperform the index. We're seeing a slight pickup from the past 2 years, although it's minimal, but it has been improving since 2023. When we look at some of those names like the Magnificent Seven, who really drove performance over the past couple of years, that is where we're seeing the dispersion sort of come back, and we're seeing some broadening out, some breadth improving when you look at returns. So this slide highlights the Magnificent Seven, looking at the performance of those 7 companies over the past couple of years. It really was driving the returns, and you can see in the top left, over 50% of the market returns came from those 7 companies going back to 2023 and 2024. Now, in 2025, we dipped below 50%, although still a high level at 46% of the returns came from those 7 names. But the bigger story here is if you go to the bottom left-hand side of this chart, is the incredible earnings growth that those companies have been providing. Will that be sustainable? And you can see it has been on a downward trajectory really since 2024. That earnings growth is declining. And what's happening is the rest of the index, we're seeing improving earnings growth there. So you can see the 493, we are seeing those converge, whereas the remainder of the index has been providing higher earnings growth year over year. And on the far right, we show the dispersion of those 7 companies versus the rest of the index. Dramatic outperformance in 2023 and 2024. As we finished last year, only 2 of the Magnificent Seven names were actually able to outperform the overall index. So much less dispersion in returns there. So I'm going to pass it over to my colleague Joe, who's going to go through what we are seeing in the economic data.
Thanks, John. I think that painted a really strong picture of what returns and what drove returns in 2025. With regards to the economic overview slides, I want to talk about the economic situation that we're seeing in the United States, mainly talk about the labor market, the inflation dynamics as well, and then how that's kind of leading into our expectations with regards to equity and bond market returns moving forward. So inflation can be measured as a year-over-year change in prices for a basket of goods. Headline is all goods and services. Core strips out food and energy, and it's just a more stable and less volatile picture. As you can see, prices rarely ever go negative. They're typically always increasing at some rate. What we target in the US is a 2% increase in prices on a year-over-year basis. That was not the case in 2021 and 2022. We had extremely high price increases. Right now, it's looking much more consistent with pre-COVID levels. So we're moving back into roughly that 2% level. And as you can see, I put some arrows here on other time periods where headline CPI was actually higher than it is today. But people weren't really talking about inflation as much in 2016, 2018, and 2011. So we are definitely moving back into a better perspective relative to the high inflation we saw in 2021 and 2022. Now, this next slide goes through the labor dynamics in the United States. I know there's a lot on this slide, so we're just going to go through these couple of areas real quick. The top right shows the job openings in the US, and that's around 7 million job openings today. This is all the job openings for all employers. And it is much lower than it was in 2021 and 2022 when employers were desperate to find workers. I'm sure everyone remembers post-COVID going to a restaurant and them being extremely short-staffed. So that's in a better position than it is today. That'll help out inflation. And then this chart here on the left shows the net changes in jobs on a month-over-month basis. And it was really strong 2023 to 2025 as those labor market dynamics shifted to a more supply and demand side matching better. But as we've seen in 2025, we're starting to see some negative monthly reports in terms of net new jobs are actually being subtracted as opposed to added. So that's something of a bit of a concern that we're watching moving forward. What is positive to see is the unemployment rate is still only at 4.4%, which is historically low looking back throughout the past 20 or 50 years. 4.4% is on the lower side. And as you can see here, this was when the government was shut down. So we actually are missing some data during that period. Finally, I'm going to talk about economic growth. This is the quarter-over-quarter growth rate for the United States. What we want to see is this light blue component being positive. That is consumer consumption. Consumer consumption drives about 70% of the economic growth on a year-over-year basis, at least historically for the United States. So we want to see consumers being in a strong standing. Now, we had a bit of a pullback, as you can see, minus 0.6% in the first quarter of 2025. That was mainly due to corporations trying to front run tariffs. So this net exports figure, they were importing much more than they're exporting, which drew down the overall economic growth rate. And we had a rebound effect in the second and third quarter. That net exports, as we're getting further into this tariff environment, is likely to not either drive or pull back from economic growth if we don't see substantial changes moving forward. So still a very strong growth picture, still in a much better picture related to inflation. And also, as I said, labor is something to watch. Finally, how does this impact the Federal Reserve's decision with regards to their effective federal funds interest rate? So the Federal Reserve hiked interest rates back in 2022 and 2023 to combat inflation. They held them steady for about a year through 2023 and 2024, and then they finally started cutting them again. So right now we're at about 3.75%, 3.75% for that interest rate, and we expect this to go lower again in 2026. But the question is how much? The chair of the Federal Reserve, Jerome Powell, is expected to end his term, is set to end his term, and the president will be able to nominate someone to take his place. That person is likely will want to shift interest rates lower as well. So we'll see how those changes to voting members impacts the Federal Reserve's decisions with regards to interest rates. So that's all we had for the economic overview in the United States. I'm going to talk about equity markets real fast, then pass it off to John to finish with bonds, and then we have some important disclosures as well. So with regards to stock market returns moving forward, we listed out some potential drivers and potential headwinds. As John said, AI, or artificial intelligence, was a major theme over the past year. We expect that to be a theme moving forward as well, as companies continue to do these massive build outs and projects related to artificial intelligence. The Federal Reserve, as I said in the previous slide, is cutting interest rates still. That can be expected to support both bond and stock prices to some extent. Global economies have continued to stabilize in areas such as Europe as their inflation comes down to a more normal level, similar to the United States. And then finally, we have some tailwinds from some fiscal related policies, such as the One Big Beautiful Bill Act, as those tax changes make their way into the economy in 2026. Finally, resilient corporate earnings are a massive part of overall stock returns. This area drove about 75% of stock market returns in 2025. So we expect, as valuations are on the higher end currently, that corporate earnings need to continue to deliver for stock market returns to continue to be positive. Now, finally, on the headwind side, we listed out midterm election uncertainty, at least historically, that has driven some volatility, stretch valuations, or stocks looking more expensive versus cheaper. It could be a potential headwind as well. Policy uncertainty and geopolitical tensions are definitely the wild card with relations to the headwinds. So changes to tariff policy or changes in geopolitical environments could definitely impact stock returns moving forward. And then, as I said, the slowing labor market, if that leads into changes for investor sentiment or consumer consumption, that could impact returns. And then finally, stock market concentration on the headwind side of things. This slide here shows the premium or discount for different areas of equity or stock markets. So over here with the arrow is a proxy for the overall US stock market. And as you can see, at least relative to history, it's at about a 40% premium to its average valuation level. So that's on the higher end. That's more on the expensive end. That's definitely, as I had said before, why we believe that earnings need to be the predominant driver of returns moving forward and not valuations becoming more expensive, because they're kind of tapped out at this point. It would be difficult for them to move to a more expensive point relative to actually becoming cheaper. There are some areas that still look cheap especially for smaller size companies and mid-sized companies. They still look a little bit on the cheaper side, but overall, there's definitely some dispersion we expect with relations to returns moving forward. The final slide I have for equity market returns, our forecasts and assumptions about it, shows each year of a presidential cycle. So the first year in office was last year, a midterm year, which is the year we're in currently, the pre-election and election year. This blue line, blue bar is the average return. So for this year, we're at least historically, there have been positive returns, as in every other period during presidential cycle. However, midterm years have historically had, on average, the lowest returns. Additionally, they've also had the highest realized volatility and the largest drawdowns during the year. So our main takeaway here is do not be surprised if we see some sort of volatility in this year of the cycle. But additionally, there is no reason to expect that we are definitively going to have some negative return environment this year, but we could experience a bit more volatility than we have at least over the past couple of years. So I'm going to pass it off to John to talk about bonds, and then Anthony will close us out. Thank you.
Perfect. Thanks, Joe. So looking here, visualization of the yield curve. And so what we're seeing here is that over the past year, yields have come down on the front portion of the curve. That's really primarily due to the Federal Reserve and their cuts of the federal funds rate. The long end of the curve really hasn't changed all that much. It's remained fairly steady, but rates have remained elevated, providing those attractive income opportunities when you think about versus historical averages. We do expect the curve to continue to steepen on the short end as the Fed continues their cutting cycle here this year. Markets are pricing in another 50 basis points of cuts this year. that would bring the Fed funds rate down to right in between 3 to 3.25% by the end of the year. On the following slide, let's look at the 10-year yield curve, because the longer end of that curve has remained in a very tight range. And you can see that between 4 and 5%, really going back to 2023. Last year, the tightness was at levels that we hadn't seen since 2021. And our expectations are for that range, that tight range, to continue. We do see the 10-year staying in a range of around 3.75 to 4.25%. Looking back historically, when the Fed funds rate is around 3%, which is where it is expected to finish the year, the 10-year has hovered right around 4%, give or take. The 10-year is also driven more by macro factors versus Fed policy. So those factors also point to it remaining elevated. And when we think about inflation, it has been coming down. It is still slightly above the Federal Reserve target. Fiscal concerns and the federal deficit. So the federal debt is scheduled to increase based on the One Big Beautiful Bill Act. Also, the decrease in global demand for treasuries as more countries try to distance themselves from the U.S. And then finally, looking at what we can expect from fixed income markets, or fixed income instruments like the U.S. Aggregate Bond Index, should we remain in this tight range bound yield level. So what this chart is showing is that where we are currently from a yield standpoint for the index, as well as the 10-year yield. And these are different scenarios given any move in that 10-year yield. So if we see a 10-year yield decrease, that would provide more appreciation. Prices would go up, and you would get higher returns for that bond index. If we do see rates move higher on the 10-year yield, that would signal decrease in prices, which would provide potentially negative returns. Now, the good thing is we have a significant yield cushion currently. And so it would take a fairly significant rise in that yield before we would have any negative returns. But given our assumptions or where we think the 10-year yield might finish the year between that 3.75 to 4.25 range, you see fairly attractive returns from the aggregate bond index in that range. So we would have to go above 5, right around 5% before you would see any losses for that aggregate bond index. So we do think bonds will play a pivotal part in a diversified portfolio. Hopefully providing some positive returns here for this year, continuing what we saw last year. I'll pass it back to Anthony to close this out.
Yeah, thank you, John and Joe, for a lot of really great information, as always, from the both of you. If anybody has any questions about this or anything related to their Henderson Brothers accounts, please reach out to your dedicated advisor. On behalf of John, Joe, myself, and the entire team at Henderson Brothers Financial Partners, we appreciate the opportunity to serve you every day in your financial lives, and we hope you have a great 2026 and beyond. Thank you.